Very esteemed participants of this webinar that is being organized by the Board of Internal Audit and Management Accounting. Very honored Charanjot Singh Nanda sir, our mentor, our vice chairman in the board, the honorable faculty, my guru, Dr. Paul Jayakar sir, the secretary of the board, Aarti Bansal, Nisarg, and other staff of the board. We are back once again with another great faculty, with another important topic, so that we enrich all of you and all of you stand benefited by the board's initiatives. Today, the board also commenced the concurrent audit course, the certificate course on concurrent audit, in which 191 members have joined the course. The certificate course on internal audit is also continuing. Today is the 5th day of the course. And let me tell you, esteemed friend, that your board leaves no stone unturned to equip each and every one of you with all the intricacies and nuances of internal audit, either through webinars, through lectures, through meetings, through publications, through certificate courses. Tomorrow at Bangalore, we have organized an internal audit conclave for the chief internal auditors. About 30 to 35 members have evinced interest to participate. It's a program where the members are invited. The expenses are being borne by the board. If any of you are interested to join the Bangalore program, you may please welcome to send a mail that you will be joining us so that we can make adequate arrangements. It is at the Hotel Fortune Celestial Park at the Racecourse Road, Bangalore, 5 p.m. to 8 p.m. Once again, I repeat the name, Fortune Celestial Park at Racecourse Road. About our Vice Chairman Nandaji, he has been a great mentor, motivator, guide par excellence. We could never receive such a Vice Chairman, such a mentor, such a guide. Thank you, sir, for always being with us, guiding us and motivating us. Paul Jayakar, sir, I am his student. The Institute's paper on computer, that is Systems Audit and Data Processing, SADP, I learned from him. I joined his classes when we never knew what computers were. And it is because of Paul Jayakar, sir, that I could pass that paper. Thank you, sir, for your the way you taught, and thank you for making me what I am today. And thank you once again. Thank you once again, sir, for sparing. In fact, you have been doing enormous service to this board. You've always been available for lectures, for publications, for meetings, and so on. Thank you so very much. I know how busy you are, and at your stage, at your level, certainly we bow our heads down to you for your services to this great institute. Thank you, Aarti, and thank you all the staff for being with us at all times. Over to you, Nandaji, for some special words of motivation. Over to you, sir.
Thanks a lot.
Thank you, Rajendra Kumar. It's an honor. Thank you.
Thanks a lot, Brother C. Rajendra Kumar P., the Honorable Chairman of the Board. More commonly known as a GST man across the entire country, he has been holding several programs on GST, involving the GST officials and ensuring that institute works in national interest by training them and putting them at the right perspective. If somebody is Rajendra Kumar's guru, he happens to be my guru. Chairman ka guru, sabka guru. So Paul Jayakar sir, I can only say one thing, that whenever I have asked Paul Jayakar sir to come, he has never said no. He is always ready in spite of his busy schedule for the, and particularly for the Internal Standard Board, the Secretary Aarti Bansal, Arun Agarwal, the technical support Nisarg, and all who have come here to go home more enlightened. Ladies and gentlemen, internal audit is a very exciting subject. Of the sunrise industry of today, it changes on a daily basis. And the topic of today's webinar is really exciting. It is the relevance of statistical ratios in internal audit. Internal audit is nothing else than a management function. And we chartered accountants report either to the board or to the audit committee. And therefore, what you report is of paramount importance. Times have changed. Earlier, there was relevance of gold. Then came oil. Then came dollar. No. Today, there is only one thing, one paramount thing that rules the entire world. That is data. But the most important thing is people have data, but they do not know how to use that data. If you are not able to analyze the data, bring the right thing, that data is useless for you. And Paul Jacker sir will take you through the intricacies of the data management. When you have the data, he will tell you how to draw ratios, and from those ratios draw inference, which can be beneficial for the board or the audit committee, as the case may be. I want to tell you that we need to understand risk management. Risk management is entirely the appetite of the board, but how we have to implement that, how we have to mitigate risk is very, very important. And we chartered accountants, either as chief internal auditors or as internal auditors or as, you say, employees of a company, take care of the entire facet of internal audit. Today's webinar is specifically designed for all those people who want to add value to this management function. Ladies and gentlemen, people at times move on two boats. There is a couplet which says, तमाम के तमाम शहर बसाकर सुकून के लिए गांव ढूंढते हैं. तमाम के तमाम शहर बसाकर सुकून के लिए गांव ढूंढते हैं. कितने नादान हैं हम, हाथ में कुल्हाड़ी लेकर छांव ढूंढते हैं. If you want to become a star in internal audit, use technology, use data analysis, use artificial intelligence, and more importantly, draw inference that could help your company where you are as a consultant, where you are working to scale newer heights compared to all competitive companies. I will not speak much when we have a very experienced faculty like Dr. Paul Jacker, so I withdraw. But I want to say that these webinars go a long way in framing the career of people who want to excel in internal audit. My salutations to the entire board who has given the chance for me to speak, and my best wishes to 191 participants who have joined to ensure that all of us work together in a unified fashion to create value and worth. Thanks a lot. Bye-bye.
Thank you, Nanda sir. In fact, let me tell you, esteemed ladies and gentlemen, that our faculty is a rank holder in CA examination. And he is one of the person who is connected very closely with the institute. He became a member of the institute in about 1976 or so, if I'm not exactly calculating it, because he is also holding a PhD from the University of Madras. The research was titled A Vulnerability Study of Web-Based E-Commerce Systems. In 2000, as early as 2005, a resident of the city of Chennai, a partner in C&K Associates LLP, independent director of Panasonic Carbon India, and a consultant to various organizations. He is one of the technology man from the South. Sir, over to you, Jacker sir. Thank you.
Thank you very much, sir. Both Rajendra Kumar and Dr. Nandaji and Mrs. Aarti Manchal has always been a support, Arun, and a whole lot of people who call me, Surab and so on. So can I start off with the portion? Can I go ahead with the lecture? Okay,
yes, sir. Yes, sir. Please proceed, sir. Proceed.
Yeah. Just a quick question. Is my screen fully visible?
Yes, sir. Visible.
Yes.
Please go ahead.
Yes. So today, good evening, participants, and good evening to the entire board of IASP, all the support staff, and so many people who helped me get things going. Today, I thought we'll have a look at a slightly different aspect of internal audit. One of them is the concept of ratios, which is very old. But now we have got, of course, the concept of statistics is old, but now we have sufficient tools, software, some of them are even open source, where auditors can actually start doing what large enterprises used to do. Now we don't have to again struggle with a lot of theory. We can go straight to the topic. We can create. I've used the Excel spreadsheet finally. I'll demonstrate that. I'll show it to you. But we can use anything: Power BI, Tableau, Idea. I mean, your comfort level, whatever you're comfortable with. So this concept of statistical ratios, I'll just quickly go through. See, I've got two photographs up here. One, which is the father of the modern statistical methods and theory. The line or few words I've highlighted is statistician and biologist. Throughout a study of data analytics, artificial intelligence, you will find that we'll have maths, statistics, and a related domain expert. Now, if you go to the second one, which is the Indian statistics, he is a physicist, physics person, and he's an expert on statistics. Now, the third one has no photograph because I'm sure once you hear all this, some of you will definitely be motivated to study more, come out with new findings where I can maybe sometime down the line, I can have one of your photographs here where I can tell them that we have a finance person, an audit person who is also a statistician and has brought it into the realm of auditing, both internal and statutory, but today we'll restrict it to internal. So that's why the third image we don't have. So that's waiting. Now I'll just go through some very simple definitions. Next 5-10 minutes, we'll close it. Now, when we relate two things and we express them in numbers, we call it a ratio. So the theory in maths is indices and ratio and proportion. Then we have another chapter called theory of indices, but mainly it's ratio and proportion. Now, like I said, there's some small example. We have here 10 boys, 30 girls. It will be 10:30. It will become 1:3 and so on. Now, these are the simple, very simple building blocks of a ratio. Now, if you take a ratio statistic, now I've taken this off the internet, so please go through as much of material as possible. I know it's not much on the internet also because finance people don't seem to like the maths part very much. They somehow feel uncomfortable, but I would suggest we can learn. I mean, you don't have to learn too much theory. We can learn the application. So if you take a lot of parameters like income, height, etc., and so on, and then we work out something, some figure, then we will have what is called a ratio statistic because they are doing statistics, but relating a large number of items together. Now, this is very important because the more factors we have, the more reliable our the more factors we have, the more. Yeah, I just got a laser pointer. Okay, the more reliable our relationship or the conclusion or the trend becomes. So that is why I have, this is only an example, but when we go to finance, we need a lot of those inputs which we are going to discuss now. Next is, why is it important in statistics? Because we always treated ratios, financial ratios as a separate topic and statistics, what we have regression, mean, median, mode, and so on as a separate topic. Now we are trying to actually, the real definition has something to do with probability. I have removed it. I don't want to give too much where you get, kind of, I'm not attracting the people to study this, but don't worry about the probability. Probability is the final outcome, which we'll see later. Now we are looking more at relationships between quantities where we want to interpret them. Easier to understand is basically the interpretation. So we are more worried about the interpretation rather than what those numbers actually mean. I get a data turnover ratio. We say that's a number of days I'll take to collect. But that's not correct. That's really a mean figure. It's not the correct figure. So we'll try to bring in some statistics also. Now, ratios and probability. Now, when you want to say something will happen, what can happen in accounts? I've taken two examples. One, fictitious balance sheets, that is window dressing and companies which will sink soon. And the other example we have taken is where they have falsified the record. So, we look at both. Now, we want to know whether the company will survive or it will sink. So, we normally say what is the likelihood or what is the probability of something happening. That's the event. Now, how do we predict that? A ratio by itself is a number. We go by, if you look at the definition of an accountant's ratio, it's benchmarked to the same organization earlier years or same year. That we call it vertical analysis. If it goes across years, it's horizontal, or it can go across industry or across same type of, not type of business, but same kind of structure, but across different industries. Not very useful beyond a point. So that's why we want to get into the statistics part. The rest of it you can just ignore for the time being. Now, what is the best thing with the income of the United States? But you can take any country. Now, if you take the entire income, which is possible today, because we have large computer systems, mathematical models, we get a parameter. Whereas if you take something from a sample, then we get a statistic. So parameter versus a statistic. Now, see, statistic, because in companies, what normally happens is we look at all the data for audit. Because now we are gradually discouraging sampling and encouraging 100% data checking, or whatever we call it, audit, scrutiny. Because we have systems today, we have computers, we have software. But there is still somewhere we could need to look at the statistic when we are talking more in terms of the probability, not so much correctness of data, compliance test, substantial test. Those are the things we do. We want to go one step further and see, can we predict something from the data we have found? Now, the word used here is fraud detection, but fraud is a strong word, but today we are forced to use it because of the company law, both in India and SEC and PCAOB, and European regulations also. And also we have a lot of regulators, IRDA, RBI, EFRDA, and TRAI, and so on, where they keep using this word deception. Basically, it's deception, even if it is done unknowingly. Very rarely, because in most companies everything is done knowingly. But okay, even if it is done unknowingly, proving that it is not a fraud is something which is the company has to figure out. So I'll just take a few points here. One, prevention and detection. Now, fraud prevention, we go for a lot of controls, but those controls are not adequate today. See, even in cybercrime, we would like to predict the crime rather than, find new types of crime and predict it rather than just trying to prevent known crime. So it's not just for financial crime, it's for anything you look at: stores, inventory, people, HR, talent. We have seen lots of problems now, like TCS had a manpower problem. Different companies have different types of problems. So prevention, I'm sure they had controls. There won't be a system without controls. But controls were not sufficient. What happened was we looked at only what we knew. We could not look at what may possibly go wrong. That is why we now stick to the detection part of it. Now, prevention, I'm not saying it's bad, but it's not strong enough for today's problems. So what we are doing is we are trying to bring it down to detection. Once the fraud prevention has failed, it will fail because prevention can only work. So, for instance, we have a new disease. we have to again get into detection and then find a prevention in a vaccine. Because COVID is there, we use that as an example, but not necessarily. It can be anything. So tire, regular tire to tubeless tire, we have all kinds of new things happening. So we need to look at this detection a little more in detail. Now, one is we have, when we want to do the detection, we have data sets. And second, the data sets keep changing. In simple words, we call this as big data. Big data is, could be our own data, can be third parties' data. In fact, most of the, of course, today's class will all be based on the company's data. But many audit predictions are based not on our data, but not the company's data, but on external data. It's a bit, it's a bit difficult to accept this because auditors work only with the organization's data. They don't get into all the other data. So over a period of time, yes, we have evolved systems and methods to detect problems using external data. And of course, the transactions, calls, etc. We start using statistical models, not plain arithmetic ratios. We are now going one step beyond. Now, statistics, okay, I'm just selling the idea. Statistics, we can maybe in another later session, we can look at machine learning, then we can go to other things also. Let's start with statistics. They provide an effective solution. Second is statistics can be applied. These are all the Indian headaches like money laundering, e-commerce. I just put credit card, not necessarily, but anything on e-commerce, telecommunication fraud. Okay, there are a whole lot of things. So we can apply this to a lot of things. This list is not complete. It's just an example. And if we go to the tools and models where we can use the fraud detection, we'll find there are a lot of them. I'll just stick to 5 or 6 of them today. Then we can look at all applications, whatever be the size, and we can classify it as organization level tests and data level tests. We got two separate test parameters, which we are trying to use and learn. And let's see if we can learn something out of it. Okay, so now I've taken the first level, which is the organization level test. Now, in the organization level test, we have two things. One, where we have people who have manipulated the numbers in the accounts. So when you manipulate numbers in the accounts, usually we have to go back to our source documents. We have to do a lot of things to find out is it working, not working, and so on. The numbers correct, wrong. What we are saying is we can do it in an easier way. We have two of them, Montiers and Benish. Then bankruptcy is companies which are going to fail. We are not saying they're dishonest. Could be siphoning of money, but they are in the process of going to fail. So then we have what is called as the Olson, Altman, and Pietroshi. That is the in Japan. Anyway, all these are researchers mostly from the US. But we have the coefficients adjusted for Asian countries. Now, maybe we could work further on this to adjust the coefficients for India, specifically for Indian conditions, because our capital markets are also growing. Now, I'm going to the theory part quickly, so we'll have a quick look at each of these. Now, the first one is called the Montiers C-score. Now, this is a score between 0 and 6. So what it's trying to tell us is we are going to find a number for we're going to give a 1 point for each of these following 6 points we have here. Now, if you find there's a growing difference between net income and cash flow, you give 1 point for it. If there's no big difference, only it's like very small, then put a 0. Don't give it a point. If you find your receivable days are going on increasing, it gets a point. Doesn't significantly increase, 0. Inventory days, again, if it is increasing, 1 point, otherwise no, 0. Other current assets increasing, you get 1 point, otherwise we leave it as 0. Declines in depreciation relative to gross fixed assets. That is, if we have ratio between a fixed assets and the depreciation, and it is not showing a constant or a reasonably constant value, not showing, then you get 1 point. Total asset growth in excess of 10%, again, it's a suspicious trend, so it gets 1 point. Now, if all of them are there, you'll get 6 points in the worst case scenario. If nothing is there, you'll get 0. That's the best case scenario. So when you want to interpret those numbers, we put in there those points. 0, we said there's no manipulation of earnings. 6 is the maximum evidence of manipulation. So where do we cut off? So normally we'll take 4 for 3. Depends on the type of industry also. Somewhere between there, we'll know whether the company is manipulating or not manipulating. Okay, how do we do this? Just going back to the previous slide. How do we do this? We take our whatever balance sheets we have, you can download them from the internet, any listed company. Try to take some fraudulent companies, recent frauds. Now you can always look at Satyam and all those things, but you can look at the recent ones also. And you will find the moment you worked out all these numbers and you gave those points 1 to 6, not 1 to 6, 1 point for each of those 6 points or 0 for any of those. The final conclusion lets you come to a conclusion, lets you definitely conclude whether your company is doing well or not doing well. Now, the second issue I'm looking at is the Benish score. Now, here we have 8 indices. The first one was 6. Now we are going little more, so it's 8. And these are again the same thing, manipulations is what we are searching for. And actual data in the financial statements are used to build the calculations for the overall score. Now, what are those figures we're going to use and what is the overall score? The next slide. It's slightly longer, but I'll explain step by step. M is the final Montier score we are getting, so we'll ignore that for the time being. It is equal to minus 4.84. Now, how do we get all these constants? Now, these have been arrived at by researchers. This is taken for Asia. The numbers I've taken here for Asia. We can do it for India also. There are a lot of PhD students who do their financial whatever research. So they can be used or they can help us out in this. Even project students, if they are from MBA, they're real good students. So this minus 4.84 is a constant. Then these are the weights, 0.92, 0.528, 0.404. These are the weights. Weights for what? So each of these are here. So the DSRI is Days Sales in Receivable Index. It's a ratio. The day sales is the American English. We generally use British English in our commerce book, so it will be receivable in days. But that's okay, it's the same thing. Some of you reading the newer books will find the American words, older books will find the British words. So we have the day sales and receivable. The GMI is gross margin index, that's a gross profit. AQI is asset quality index. SGI is sales growth. DEPI is a depreciation index. Some books may have DI, it's fine. SGAI is selling general administrative expenses. This will kind of remind you of the old cost sheets we used to work out, prime cost, the direct cost, then add the factory overheads, etc. like that. So we go step by step, administrative expenses. And then TATA is the total accounts accruals to total assets index. And LGVI is the leverage index. Now, what does all this mean? So first we have to work out all these ratios. You'll notice that we have 8 of them. There we had 6. Montier we had 6. We increased it. And also we have not given 1 point, 0 point. We have used some weights. Now these weights are calculated based on large number of balance sheets. Actually, in India, we have about 7,000 limited companies, maybe more than around 1,000 will be the real active ones. We have the first 1,000, then we have Nifty 50 and 500. You're free to take whatever you want. I suggest we take the 1,000 if you're researching. Otherwise, we can wait because a lot of researchers can do this. These numbers are Asian numbers. Specifically, India, weights could change a little bit. I'm sure they will change. Anyway, that's fine. But once you put in these weights, now we get the answer. If your answer is greater than minus 2.22, then you got the company's really got higher probability of financial manipulation. Since this number is negative, we have to remember minus 2.21 will be greater and minus 2.23 will be less than, because it's a negative number. So that's why. But that's okay, that all of us will know. But the main part is we need to work with more ratios than we did for the first one. Mondias needs a little more, so 8 of them. Now, once we get the answers, yes, we can definitely look at them and we can come to some conclusions. So, okay. So now what we do is we go to the next one, which is the Altman's Z score. Now, the Z score, we have some common business ratios, 4 or 5, that depends on whether ratios, all of them are possible or not possible. Again, we have coefficients 1.2, 1.4, etc. Now, each of these x1, x2, x3 work with ratio. These are standard ratios. Working capital by total assets, retained earnings by total assets, earnings before interest and tax by total assets. Up to this, it's all asset based. Then market value of equity by book value of total liabilities, and sales by total assets. Now, what are we going to do? We are going to calculate each of these ratios, put those numbers as x1, x2, x3. It will be 1.2 into whatever answer we got for x1, plus 1.4 into whatever answer we got for x2, and so on. You'll get the Altman Z score. Now, this score is slightly different in the interpretation. If it's greater than 2.99, it's a clean company, nothing to worry about. But if it is between 2.77 and 2.98, there is a chance that something could be going wrong, but you'll have to investigate thoroughly. But if it's like 1.87, 1.8 and 2.7, this company is definitely going insolvent. If you kind of recollect, when Caro issued the note, one of the questions was, will a company be able to pay its debts? Now, you'll know from this ratio straight away whether it can pay its debts or not in the coming years. So what we find is somewhere the regulators also are using a lot of these mathematical techniques. Probably somebody teaches them and they bring it as form of standard questions. And instead of suggesting what to do, they simply say, answer this question. Then how do you answer it? We need to work on methods like these. Now we have the next one, which was a long story. It's the Olson's O score. O is because it's Olson. Now this is for predicting financial distress. Now it's a long story. I know the slide is not very big, but its a coefficient is 1.32. That's the absolute coefficient. Then we have some 0.407. This is a logarithm, natural logarithm. TA by GNP will be total assets by gross national product. Now we are looking into the economics of the country also. Now, one of the reasons why we have to do that is if the countries are located in high inflation countries, or if they are in politically unstable countries like Africa, okay, we're not mentioning all the African countries, but some of them South American countries. And now we find in recent years, even countries which were stable are becoming slightly unstable, like Malaysia, for instance. Or generally, we'll know from the currency exchange drop, or we'll know from a lot of parameters, economic parameters, macroeconomic parameters. We need to look at the GNP for those, if they're in such countries. Stable countries, then don't use also. Then we have this TL by TA is again total liabilities by total assets. WC by TA is working capital by total assets. CL by C again current liabilities by current assets. We have the NITA now. The next one, actually, there are, okay, this NITA also is not a problem because we know what this NI and TA stand for. Now, the problem comes when we get into some of these calculated figures, like this 1.72x, and somewhere we have this 0.285y. Now, the x is and y is here. If total liability is greater than total assets, 0. Otherwise, you have to put a 1. If, again here, 1 if a net loss for the last 2 years, otherwise 0. So that's the x and y part of it. And then this is not very clear, this logarithm here, ni n and ni n minus 1. I just pasted another picture which I will show you. Now this is the actual formula. By the time I put it in a straight line, it's not coming out too well, but this is the formula. The coefficients are all the same, but where we have these at L by T, that we understand. But when you come here, this part, this NL minus N and Ni minus Ni for 2 different periods and the Ni plus Ni for 2 different periods. This is the one here. Need some brackets and so on. We had to explain N minus 1 and N plus 1. What does it mean? So it's nth period and the previous period. N minus 1 is the previous period. So if we are taking a March 23 balance sheet, N minus 1 is the March 22 balance sheet figures or financial figures. Now, if we run through this formula, then if your score is greater than 0.5, the firm is in trouble. So it's going to default. We say within 2 years, but that's an Asian thing. But actually in India, sometimes the companies take a little longer, 3-4 years, because they are able to manipulate third-party finances like bank loans and so on. But okay, let's assume banking gets strict and everything gets really strict. Then your figures of 2 years will be correct. Otherwise, 3 years maybe. Some of them go to court and keep dragging for a few years. Basically, they don't do business. Then technically they are not declared insolvent, but they're not doing any business either. So we know that. So we can easily understand these numbers. Now, if you go to this Pytoshki's F score, okay, the answer is between 0 and 9. That's fine. Now, we calculate this on 9 criteria, which is divided into groups of 3. So first we take profitability, then leverage, liquidity, and source of funds. Finally, the operating efficiency. Now let's look at the profitability part. See, why do we take these 3? Because in any organization, if you're going to sink, I mean, if your business is not doing well, they may be facing profitability issues, which is very common nowadays because we have this concept of value engineering, where the buyer fixes the price and asks the supplier to match it. They have to do a lot of cost cutting, etc. If they're not able to do it, then they are in trouble. So this happens to power plants. It happens to certain logistic companies with long-term agreements. A lot of places we find this happen. Second, leverage, liquidity, and sources of funds is we used to talk of capital gearing, which is like the debt equity. I mean, the relationship between borrowing and own funds. But now it gets much more complicated because the treasury management models are extremely complex. So you can leverage on so many things by, I'm not saying we're not paying, that's simple English, but you can stagger the paying by restructuring, or if you're seeing credit cards, one card company takes over the outstandings of the other card companies. So the person is rolling over the outstandings. There are a lot of new techniques which have come in. We call them products. I mean, the industry calls them products. Are they all good? Some are good, some are not so good. They encourage indefinite rolling. And even in banks, so those doing bank audits should have seen this evergreening is another painful process where insolvency is covered up and people pretend as if it's a running loan or it's a performing asset. Then operating efficiency is purely the company's way of doing things. I mean, how they handle their business. So on the profitability, we have return on assets, we have operating cash flow, we have the change in return on assets, and we also have the accruals. All of these, because anyway, I'm not going to any specific example, but if you probably go through Satyam's records or if you, I mean, financials or any company for that matter, because all the case studies we read about WorldCom, Enron, H1, Hydro One, Reebok, Diageo, so many companies, if we take the financials, or even our own ABG shipyard and so on, or even ILFS, so on, you'll find that you have assets not matched by proper output, I mean, increase in production. We have sales not matched by cash flows, but matched by debtors. There are telltale signs. If somebody worked out, you definitely get the answers. The leveraging part I told you is actually leverage long term, current ratio and the number of shares. Unfortunately, here, when we say long term current, you have a lot of products, companies, innovation. Innovation means that finance innovation. They come out with so many complicated things. So we need to, in fact, we have got a whole lot of chapters there, derivatives, so many things out there, options, swaps, and it's a long story. So depends how complicated the company is. You may have to do a lot of homework here. This is easy. Operating efficiencies, gross margin, and asset turnover. So if you are able to get all these ratios in position, then 8 to 9 is considered strong. This is the worst case scenario, 0 to 2. But in between, of course, there are levels of weakness which we have to work with because we'll know. I mean, as auditors, internal auditors, you'll know what is acceptable in a given industry. Now, one of the problems India faces is we have a lot of service industries. It started with BPOs and okay, even audit firm service, hospitals and so on. But slowly what happened was the services have extended to maintenance contracts. It has extended itself to event management. It has gone into a lot of areas now where there was no such service being offered earlier. So what we now find is definition of a service itself is becoming difficult, and sometimes, let's say we have outsourced something. The definition between procurement and outsourcing itself is a gray area now. Are we procuring the service or are we outsourcing our work to somebody else for a fee? So maybe as we learn more and more on the audit side, we'll definitely be able to. I'm between 9 and 0. We'll definitely be able to grade it. Now, right now, what I've told you is 0 is the worst, 9 is the best, and so on. But grading is required for different industries. The same industry rendering, say, normal data entry service will be completely different from somebody rendering a diagnostic service or a different kind of service like maybe refueling aircraft, just the refueling. They don't sell the fuel. They only do the contract for filling aircraft as they come in. So there are differences. Now, when we go to these tests, we need to look at a lot of parameters. Of course, we need the inputs, the data. What inputs do we require? I gave you some ratios. I said we could work with those and definitely we'll have all the stuff we require. Because the ratios we know, numerator and denominator. But then how do we classify things? For instance, horses or cattle, dairy farming, they go under fixed assets, under livestock. But if you have chickens in a poultry farm, they don't go under livestock, they don't go on for an asset. So we have a lot of difficulties in identifying what is a textbook question looks simple. In real life, it gets extremely complicated. For instance, we have baggage handling systems. We give a car parking contract. Now, the companies are huge. For instance, even housekeeping companies like SAS and or JLL or whatever, or rent broking companies. Now, real estate, they call them realtors, whatever. Now, what do we need? How do we define what is total assets, what's total liabilities, what's the gross national product? Do I take it for a region? Do I take it for the whole country, which doesn't affect that particular region? Then we have something like identity. Organizations, as we know, better transparency comes with listed, then reduces to unlisted, then private gets less transparent, LLP, partnership, sole proprietor, we get no data. Locations, these are very important. I'll give an example. Some few years back, when the income tax, the finance minister said you can file returns up to 5 lakhs, but you don't have to pay extra tax. Most of the low cost housing people, it's called LAP, loan against property. They're mostly small properties where they're changing the roof or adding a roof or building a toilet or something. All these fellows went to some bad auditors and refiled all their returns. Taxman is happy because he said no extra tax. There's only just pure paperwork online. But when it came to the finance companies, they had a problem because this fellow's credit rating goes up. Where he was filing a tax return of less than 2 lakhs, now he's filing a tax return of less than 5 lakhs. So their models, the macro, that is IFRS 9 or Ind AS 109, where we do the expected credit loss. So the cash loss. So what happened there was the credit rating went up with really no real increase in the rating of the applicant. So this happened mostly in the western region, particularly in Maharashtra. So all over India, because GIC and all that lend all over India, but this peculiar trend was noticed only in one uh, part of one state. Now that is again, we can't extend it to the whole country because other places the fellows didn't bother filing revised returns. Then frequency, how frequently these parameters change. Actually, they change continuously. We average them. But now we have ERPs, big companies, they have ERPs and so on. Now with audit trails and things like Tally, TDL, Zoho, even small companies, you can stream the data and analyze. Of course, financial amounts, that's a human decision. It's a relative decision. Okay, then we get our output. We said 0, 9, 1, some numbers we gave minus 2.2 and all that. Now, all this was at the organization level. We were talking about window dressing and going insolvent. Two different, we had some ratios to illustrate each of them. I would like you to, it's a personal request as a teacher, I would like you to try these out because I know not many auditors have much faith in these statistical ratios because I think it's some number juggling we are doing. We are not seeing the data. Or I need a dump of the data and so on. Not really, because I'll give you a fair example. Infosys had an allegation by some employee fellow in the US where he said Infosys was window dressing its balance sheets 3 years ago. Infosys refuted the claim. They said we are not doing it. So the SEC hired a consultant to say whether this window dressing is true or false. Within 3 weeks, they submitted the result. You know what normally happens in India is even a small audit, we call them forensic audits, but even a small audit like this will take months. They get right down to the transaction level, source document level, authorization. It's endless in the story. But what these consultant fellows did is they used these statistical models. Of course, they used a few more of these. For today's class, I just kept it simple. I'm trying to get this idea across. They used a few more models, but basically these models. And then they knew there was no manipulation in Infosys's financial reported reported financials. So then what happens is, so once we have, there was no reported change in the, no reported kind of indicator, SEC, that is Securities Exchange Corporation, they gave a clean report to Infosys. Now that was an eye opener for many of us in the consulting industry, where a large corporation like Infosys, a thorough check and a conclusive answer, yes or no, was possible because of these statistical methods. So now if we look at this, that was the first part of the story. The second one is what we generally do, data level tests. These are more for statistical work. You can use Power BI, Tableau, you can use Nine, you can use Excel if the data is not very voluminous, or if you have somebody who can write Python code or any code in basic Java, whatever, you can use it. Classification, as we know, is we classify the data in different ways to find patterns. Okay, normally we classify income-wise, age-wise, location-wise, and so on. But sometimes we need to classify on two or more parameters or two or more fields. They call it metrics today. So let's say we take sales and we also take a location and we take the sales manager and the product. Now that classification is a little more difficult because we are now trying to mix four different things to see whether which combination is affecting sales. We don't know what's the combination, but we know the metrics in the combination. And when we take those four things, we find sales high, low, etc., whatever. Now we have to find out weightage of each of those in that mix. Is it a good salesman who's increasing sales, a particular product which is required in that locality, or is it the pricing? Is it the credit period of so many things? So the classification today, of course, we got tools. This is no longer the old statistical calculations. We got enough tools today. We can classify. Now, statistical parameter calculation is the next thing. So this is to detect whatever we are trying to find out. And we have several methods. But the thing is, I'm not looking at fraud only. Americans and Indians also, they're using words. Even forensic they use. Forensic means you need to have data which will stand the test of law. All forensic evidence must pass the cross-examination test in a court of law. So I'm going with the same word, fraud. What it means is some kind of manipulation or dishonesty, maybe slightly also, maybe huge. I mean, that we'll have to look at. So we need to work out some statistics. Mainly what we'll do is we'll look at things like regression or clustering or any other simpler ready-made methods for which formulae are already in the tool we are using. Then we stratify numbers. Now, how do we do it? Let's say for amounts is the easy thing. We say it's called monetary unit sampling. We'll say we'll take vouchers above 1 lakh, 50,000 to 1 lakh, 0 to 50,000 something. But that's not necessarily a good stratification. We may have to look at other stratification. And some of these will be, just giving an example where, let's say deposits which are somewhere between 49,000 and 50,000 because they don't want to give the PAN card. We keep it a little below that. Or where they're trying to avoid, actually they think they're avoiding, but they're not. Where you split a bill into 3-4 amounts and then try to pay through different credit cards, but it's the same supplier. So anyway, it'll get caught in GST. So people don't understand too much. But anyway, what we're saying is the government is one of the largest users of data analytics. They have a full lab. Okay, they use the defense lab, but they also have a full lab. CAG has a full lab in Delhi. So they have a lot of capabilities. If they want to, they check a lot of stuff. So the stratification is not always amounts. It's not always ages, locations, voucher numbers or months or whatever. It can be anything. It can even be time. It can be actually, if you see the notices which Amazon, Flipkart, Myntra get, earlier they would have sales at different time slots. If you notice now, the sales almost coincide. Amazon, Flipkart, Myntra, all these fellows. So what the government does is it monitors because their sale goes into billions. Volumes are very high. In fact, the Economic Times, I think this week, Monday, they said how not to waste your money on sales. The sales, sale means this so-called discount sales. So the government stratifies it differently, and Amazon, Flipkart, and all these e-auctions, electronic commerce, wherever it is used, they stratify differently, including time of day. That's why they have midnight deals because youngsters today they use their phones or computers late at night, so they try to catch that crowd also. So there's a lot of stratification. Then joining unrelated sources. That's what it means by actually, there's a subject called diverse data. We need not go into that now, but as auditors, we have to learn. By looking at other data, I'll give an example. Google has secret data center locations. They don't tell us where it is, but they'll say it is somewhere very safe in a desert, in a mountain, in some bomb shelter, European bomb shelters. This one American fellow, of course, they're all youngsters who want to challenge things. So what he did was he started looking at all the desert areas in the US. Arizona, Nevada, they're all deserts. Then he found out the power consumption in the desert because servers consume a lot of electricity. Then he tried to find out vehicular movement in that locality, different localities in the desert. Then he found out pizza deliveries in different locations in the desert, where there was a common point: heavy power consumption, heavy vehicle movement because they have to use cars, they don't have public transport. Heavy pizza deliveries because these guys order and eat. If he said this is roughly where the Google data center is, and that was correct. So what I'm trying to say is, auditors, sometimes the client may be non-cooperative, possible, or we are not able to understand the data properly. It happens in many of the ERPs and homegrown systems also, where the guys have left or nobody understands where the data is, how it is to be joined. Then, as I told, I just gave an example of big data. But anyway, using these kind of data, we can come to conclusions because today, police in Tamil Nadu catch a lot of people based on toll gate data from your FASTag, from a card usage, mobile phone usage. There are a lot of other parameters they're using other than fingerprints and dogs and the traditional methods. They use CC cameras, a lot of stuff they analyze. Now, duplicate testing is again very important because again, it's a small time fraud, but it's big fraud, but small amounts. In some states, one particular state in southern India still has a lottery. They have a scratch lottery. You buy a ticket and scratch it, and if you get some last 3 digits, last 5 digits, something like that, you'll get 5 rupees, 15 rupees, something. Buy a 1 rupee ticket, you'll get a little more back. So what happened was these fellows bought these tickets, they would scratch it, they'll get some ending number, they'll collect 5 rupees from the shop, 10, 15, whatever the amount is. And the shopkeeper will minus it when he's giving the account of these tickets sold to the stockist. The raffle tickets go through a stockist. But what some shopkeepers are doing is they were fraudulently claiming the winning numbers. Actually, when they scratched it, the fellow didn't win. But they simply say it had the last 3 digits, it matched the last 5 digits, and they deducted the 5 or 15 rupees and were remitting less amount. Now, when the lottery, that's a government lotteries actually, when they had to reconcile the stockist winning tickets, if they had given 10,000 tickets which won 5 rupees, they found 1 lakh tickets were claiming 5 rupees. Of course, they were not able to trace which stockist immediately because again, you have to go the serial numbers for a small amount like $5. It's not worth it. But at least they found out the fraud. Then they got stricter on it. So they said you can't deduct from the money you're giving us. The money will be paid by the stockist to the fellow who's got the winning ticket. So duplicate testing, we got so many examples in India. So where it's not always voucher numbers and whatever receipt numbers and roll numbers. It's also a lot of other things. Like gave an example of lottery, parking tickets. What the guy does is takes the ticket back and reuses it to another vehicle. So the same ticket this fellow is collecting money 2 or 3 times. But if you notice the number, it will be out of sequence. That's why now they print the number. When you take the tag out, it prints a unique number and gives it to you. Then gap testing is the opposite of duplicates, where you're leaving out values. Basically, they have removed data. They have wiped away the data, and that is again a problem because we don't know what they wiped off. That's why we talk about audit trail, but it is again a computer-related thing. One of the problems the auditor could face is if the fellow is able to edit the audit trail and the data, it's difficult to find out. So we need hashes, hash values, or checksums on the audit trails because the gaps could be very troublesome. They could be a very difficult area to trace also. Then entry dates. We say closing period, opening period, cutoff period, so many names we use. But generally what happens in business is backdated entries are sometimes necessary, at least they are common. So with backdated entries, how do we trace them? So that is one of the issues we have. However good the ERP is, you could have parked it, posted it, reversed it, forwarded it after some time because the accelerator effect. Tracing an entry backwards becomes very difficult. Many of you have faced a situation. You can tally the Sunday creditors in total, but tallying each creditor's account balance becomes a nightmare. So these are the entry date problems. Numeric value summation, of course, that's again another problem. One is accuracy of our code. We could also have things which don't work. They break down. Arithmetic errors in our formula. There are a lot of things we do. So what we normally try to do is work with close numbers. We are not actually looking 100% of the data because sometimes the data is missing. Then you have to exponentially smooth it. Now, financial values, I understand, it will be correct. But what about things like quantities, distances, a lot of other numeric data we collect, dates, multiple entries for the same transaction, open POs or multiple deliveries. Those will need summation, maybe only approximate. So we need to have a statistical method where we can guarantee the approximation. So here, if you see, there's a small graph where we are talking about static testing, which is our routine, how we do it in auditing, then dynamic testing and real time. That is the runtime monitoring is real time. Can we do it? Actually, in audit books, you'll find the name streaming data, STREAMING. That's the old real-time data. Data is coming all the time and you are continuously monitoring it. So when you are doing that, your reliability will be far more. The other side, rest objective, you'll have many objectives. You have functionality, security, etc. I think most of us just stop with conformance. But we need to go a little more, reliability, maintainability, and data quality. So that is when you have continuous monitoring of the data. Now, if you had continuous monitoring of data, some of the frauds we see, like the Cosmos fraud, that was the ATM fraud. If you look at even the recent Bank of Baroda app fraud, none of these apps are really monitored real time. Maybe you're all comfortable with banks. They have a lot of software, but the vendors are not very knowledgeable. They charge them huge amounts. The buyers just want to look at compliance, like RBI compliance or IRDA compliance. They're not really bothered about what can go wrong or who can do mischief. So, anyway, it's a long story. Unless everybody, the user, the auditor, everybody becomes knowledgeable, it's going to be a very difficult task to reach this level where we can say that data quality is good because we are monitoring in real time. See, in security systems, they do it. That is only for the cyber money. Money going through internet is monitored in some cases like this. But otherwise, normal data, let's say attendance, time and attendance, we probably stop at conformance or even probably performance. Stop there. In sometimes we probably just stop at functionality. That will do. If it records the in time, out time, we are more than happy. So we need to move up the chain in terms of data. So that's another story which we are trying to sell. Now I added one more. we added one more called the hidden Markov model. I just added this one slide because I want to bring in this probability and traceability, because today we talk of audit trail. Audit trails are okay if you just have data. I mean, you just have some data, I modified it, I put on, okay, I issued a check, guy didn't encash it, it kind of got stale, I canceled it, put a new check. That's okay, I can get the trail, what did I issue, old check number, new check number, which replaced the old check, etc. But let's have a look at this. The Markovian model, what happens is we can trace the data back and forward. Changes are constant, that we agree. Just leave the hidden out for the time being. Only the Markov model. Changes take place and we have an unobservable states. Once it's hidden, actually we have observable states, I'm sorry. If you leave the hidden out, we'll have observable states. Now what we are saying is, if I look at a particular entry, I can tell you what the earlier entry was. Or if I look at something which is happening, so satisfaction, emotional coefficient or sentiment analysis or whatever, I can tell you what happened before that. Delivery was delayed, person was unhappy. Or maybe it was raining, so the Uber or Ola rates went up. We can definitely connect them. It doesn't rain every day, so Markov says you can expect unexpected things. We agree with that. But when something happens, you will know what triggered that action. You can always go one step backward. That is what the government has meant when he said audit trail. But now we have another problem. Of course, this the government does not. It'll happen. I mean, once the company starts cheating, they'll find out. We have something called the hidden Markov model, where we are not able to identify what caused the action. Now, to give you another example, Google Maps shows traffic congestion. Now, one of the fellows, what he did was he put a lot of Google phones, over 100 Google phones in a like a trolley-like thing or a small thing which you could pull along. And on a deserted bridge somewhere in US, he put these 100 Android phones, Google phones in the trolley-like thing, and he pulled it slowly, he walked across the bridge. The bridges can be quite long in those countries. So he walked across the bridge, or maybe a bridge like Hyderabad or the Worli ceiling, something. He walked slowly and he went. So when these phones moved, like 100 phones moving together, Google Map, their GPS detected that the movement of traffic is very slow, because these phones are generally, pedestrians have only one phone, you won't have 100 phones. So they thought traffic is piling up, it's like a traffic jam. So 100 phones moving at a very slow pace. You have definitely seen, your Google can also show you the speed at which you're moving. So they marked that area as heavily congested. Once it was shown heavily congested, the motorists avoided that route and took some other narrow route, and they created real congestion. Actually, the bridge was not congested. This fellow created fake data, was able to create fake data, which caused this trouble. Now, if a phone is moving slowly, does it mean there is traffic congestion and the vehicle is moving slowly? If you are not able to predict that, then it is hidden. If you are able to predict, then it is not hidden. It's simply Markov. If you are not able to predict, it's hidden Markov. So, of course, Google also learns lessons. We also learn lessons in auditing. That sometimes you are not able to trace a transaction of same type, 1, 2, 3, same type. One traced to event A, two traced to event B, three traced to event C. Now, this can be a major problem. That's why they use the word influenced. Because there are things like this. There's no PO. They take in the stores and issue a PO in the morning. Okay, why do you do it? Because the lorries are piling up, they have some problem. Okay, we shall store it. Okay, fine. The reason was there, we were able to trace. So any PO issued in the morning after 9 o'clock office hours, meant some trucks got piled up and there were no POs. Some issue, then root cause they'll try to trace. But it's also possible a fraudulent gatekeeper is in collusion with the supplier and without a PO they're supplying and collecting bills. Now that means when you trace a delivery taken in the night, it may be because of a genuine traffic congestion buildup of lorries, or it may be a collusion. Then we have a hidden Markov model. Now, this is the problem with the audit trail. It may not, no, right now, nothing wrong with the audit trail, it's fine. But what I'm saying is smart companies will find ways to have an audit trail, but mislead when you try to move backwards for reconstruction. So here, for a hidden Markov model, there is no one-to-one correspondence between the outcome and the previous event. Okay, states and symbols, ignore that. It's between the outcome and the previous event. So if you find an empty teacup, it doesn't mean a human drank the tea. It's maybe some cat or something came in or a bird came in and drank it off also. Okay, these are the silly examples we give in classrooms, but in real life, people, it's called covering the tracks. So people pretend as if an event which is you're seeing now was caused by a different event and not the fraudulent event. So that is the next problem we'll face with our audit trails. Slowly it'll start. I mean, there are enough people. I don't know, for good things they'll never apply their brains, but for bad things they'll do a lot of innovation. So that's what we are looking at. So when if you say it's no longer possible to tell what state the model was in, model means the process, when X was generated by just looking at X. We don't know. X was generated through a process, but not necessarily it is a strict process. It may be a loose process. That is why you use KNIME, K-N-I-M-E, to trace data on the processes. And you'll be surprised when you look at large organizations. We have crores of transactions per year in a year. And there's a big process, PR, purchase acquisition, POs. Okay, there's big story maker, checker, this, that, whatever. You put this 1 crore, multiple lakhs of records into your KNIME and process it, you will find that many processes have been bypassed because it's no matching process against data and the moment it went through. Many processes are bypassed. If you ask the organization, they'll say, okay, some reason they'll tell you whatever, somebody was not there, emergency purchase, it was delivered to the wrong site, so we had to divert. Okay, whatever, some stories, but how many are true, how many are false, we don't know. So one of the problems the internal auditor has with that fictitious, we took a few models earlier, but once you get into this kind of a problem, the difficulty is you need to have a better tool. It's called data mining, M-I-N-I-N-G, data mining. I used to tell students to use Prom 6, but now I suggest to use KNIME itself, K-N-I-M-E. It's open source, you can download and install it. I mean, I'm not saying do it for any non-client. If you have the data, just try it out. Don't have the data, don't worry. Go to World Bank or Yahoo Finance or somewhere and get some data, GitHub, Kaggle, and get comfortable with the model. So when you actually use it with the real client, because client data is confidential, you don't have to share it, but you'll know what the problem is. So one of the reasons why an auditor uses an hidden Markov model is false positives are better identified and your detection accuracy is increased. Now, you don't have to worry too much on this. I told this another time. I'll definitely take some class on machine learning. But what we are trying to say is with machine learning and this HMM, hidden Markov models, we can see, we normally say outliers, lay them out, top 25, bottom 25. See, these are thumb rules we used in statistics years ago when they were only coffee drinkers and tea drinkers. But today you have hundreds of flavors in tea. Hundreds. We got peach tea, jasmine tea, some Ayurvedic tea. Now, problem is if I say you're a tea drinker, it's not enough. I have to go further. Normal tea, organic tea. Again, whatever flavor you're using. If you see the sunburst diagram for this coffee giant Starbucks, you will find that circle goes into 8 levels. So they try to find in which country what flavors will sell. And peculiarly, Starbucks is the only in China. Starbucks sells tea. The rest of the world they sell only coffee. So it's a lot of hard work, but it's called a star diagram, the starburst diagram, starburst diagram. You can just look at it. Today graphics have changed quite a lot. So we look at the levels of flavors which people select. It's not just one flavor. Those days you buy ink. Now you get blue, green, something. Now you get turquoise. You get some, all kinds of colors are there. So it's very complicated. That's where the auditor's life gets miserable. So we need to look at this machine learning coupled with statistical, which I'm talking about. So to kind of summarize, we can say first understand the business process, which is extremely important. You could learn BPM and diagrams or simple diagrams, flowcharts. Then what could go wrong? This, of course, you'll have to start building your own knowledge repository based on cases, textbooks, researcher incidents. We can build a very big repository. You can share it also if you want. Then catalog the symptoms. That is where you use Diamantier and so many Benesh and Wolfson. Bain and Marco, we just took it up. Then use technology to pick up your data. You learn SQL, it's good. You can use SQLite, it's called SQLite. You can use it, analyze the results, and of course, the investigation, analyze and then follow. Okay, it is a summary, but see, the problem is we need to have a knowledge how to interpret. We need to, identify possible thing, catalog possible stuff, use technology and analyze. These four boxes are the most important. So if you don't have a knowledge of what can go wrong, we won't have a knowledge of saying this is wrong or this is right. Because if you go to a doctor, basically they check for a few things. You have a stethoscope, you have a thermometer, you have a tongue pressure, you have a blood pressure gauge, and they check your pulse. Within those, almost 90% of your diseases can be classified. Only then they will go for the what we call the support tests, like an MRI or a Doppler or something. So we need to know what could go wrong, knowledge of diseases, then collect data, basic data, and then you know, okay, it needs further tests or it doesn't need further tests. We need to come to that conclusion. So what I have done is, okay, this is ML, and I'm not selling the idea of an ML, but maybe I will do it. I mean, before we, in some other series, we'll definitely have a quick class on machine learning in your audit. Okay, so what I've taken is I've taken a real life example of a company called WorldCom. Now, see, what I find is sometimes you get SMSs, buy this share, buy that share, something. They have technical analysis, they have discount analysis, they have time series analysis, they have so many things, share brokers, companies, mutual funds, they all do something. But basically, I know why they don't do it, but basically, what a common man cannot understand is when there are so many ratios which can indicate fraud, why do these companies go only on the share price? How much it's selling. Some of them rig the price. Some of them do it out of ignorance. So, as auditors, we are not going to depend even on the most honest company. Things can be wrong there. So, this is WorldCom, which is it's an old case. Okay, very briefly, I'll tell you what the WorldCom was. It's a company which went on acquiring internet leased lines. They acquired a lot. It is a very ambitious company, no fraud initially. When they wanted to take over the world, control all the internet, they found they didn't have wireless. So they wanted Sprint to sell the wireless to them. Sprint refused. Once Sprint refused, these fellows had no wireless. The world was changing from cable to wireless at that time. It was around, must be around the 80s, 90s, or 90s, between 90s and 2000. Suddenly, these fellows found they are lost. So they started hiding up their capital as revenue as capital, the usual manipulations which we discussed, total liability, total assets, the ratios we discussed, capital return on assets and so on. So if you take WorldCom's numbers and if you run through this, you find that gradually it has started showing differences from the industry benchmark. Okay, that is one side of the story. Now, if you go a little further down, and this is the Altman Z score, because Altman is missing here. Altman Z score, we saw that much earlier this evening. They took these ratios, x1, x2 up to x5. You can take 4 or 5, we said. They took 5. These are the ratios they took. They got it for 3 years. They did the Z score calculation. We all also know how to interpret the Z score. And you found that in 1.2 itself, it was moving into gray area. At zero point 0.7, it had moved into bankrupt area. Actually, the internal auditor blew the whistle. But that's silly because all these ratios were pointing to the same thing. Okay, anyway, we are not blaming the auditor or blaming anybody. What we are saying is, due to various reasons, things can go wrong. So, if you do an independent analysis, like I gave the Infosys and some fellow alleged they were fudging the numbers. So, if you do an independent analysis, the answers are clear to us. You don't need any further support. These are just some books I put across. You can look for them on the internet. These are not not very recent books because recent books get into statistics and maths and machine learning. Let's start with the older ones first. The older books where there was no machine learning or AI or any of those things, just the standard techniques of ratios and statistics. Then we will kind of push ourselves into the next thing. We'll move into this statistics and all. Okay, so this is my first part. Just please hold on for a little longer. I'll show you the spreadsheet. You can photograph this slide. This is my email. Not now, but even later, if you have any questions, please feel free to mail me. To the best of my knowledge, I'll explain. If I don't know, I'll find out and tell you. So we have got access to research students in universities and some of the top technical institutes in India. So they can give us the answers. So please note my mail. Please keep in contact because I notice I'm not very frequent touch with our CS students. So I'm sure you can contact me. I'm always available. As I told you, this is getting a little older and getting a little tired. That's all. But otherwise, please contact me. I'll help you. Now, just give me a minute. I'll just change this thing to another spreadsheet. Yeah. So now if you see, you should be able to see a spreadsheet on the screen. Are you able to see the spreadsheet? Is the spreadsheet visible? Is the spreadsheet visible? Um, I'm not sure how I can contact somebody here, but if you can see the spreadsheet, can somebody type yes or something in that question panel or wherever we are? If I could get an S, it'll be easy. Arun, is the spreadsheet visible? The spreadsheet, I changed the screen. Is it visible on the screen? Oh, okay. Thank you. Yes. I'll take it. Fine. Yes. Thank you. Yeah, so it's visible now. So, see, if you just look at this for the Benish, there's no data here. This is just a template. But if you look at each of these, we can type in the numbers, net sales, whatever. And as you come down here, you'll find some errors. Just ignore the error. It's a formula here. Since there's no data here, you're getting the error here. So remember those ratios we had, whatever DSRA and all the AQI and all that, those things. So these numbers will get generated. Once you fill in data, download any listed company, 4 years, 5 years, whatever you like, balance sheet. And once you get that, you will get the score for each year. I showed you the WorldCom slide. You can see the number changing across the years. You'll get your answers here. Just try it out. It doesn't have to be these years. You can go for newer data because companies at least 5 years they'll definitely have on their website. You can go to this Montier. Same thing. It's an empty spreadsheet. You can fill in the numbers here. You can work with this, and you'll get your results here. Scores. Okay. The other one is your Altman score, in fact, Z score. This is what was used in that WorldCom thing. So you can again fill up all these numbers and you will get your Z score for each year. And you have the Olson. And here you have this same thing here. You can fill up all the numbers and get the answers. The same thing, last one is the summary. How do you interpret each of these, Benish, Montier, etc. So I'll mail this spreadsheet also to you. I have absolutely no problems in mailing it. What I'll do now is I'll take up your questions. I have the questions here with me. Okay, the first question is, why is the total asset growth used as a criteria? Okay, see what happens is when you take asset growth, it has to be matched with revenue growth or turnover. So normally what we say is the more machines you buy, the more salary payroll, if it's increasing, then obviously production also has to increase, sale also has to increase. If sale didn't increase, inventory should increase. If sale has increased, cash flow should have increased. Okay, there are relationships. It's those relationships which bring us to this question Vilas Satish has asked. Those relationships is why we look at the asset growth. Next question, models seem to be targeting manufacturing. No, we have to look at service also. See, assets and liabilities in a service company will be a loans and deposits. As I told you, they call them products, but carefully evaluate the products. For instance, cross-selling products for BFSI or not so much for BFSI, it's more for the banks. Cross-selling insurance also. You have to correctly classify both if you depending on the model, of course. The macroeconomic parameters, you also have to look at assets and liabilities, and also have to look at whether the assets and liabilities have growth. Somebody asked in the earlier question. There, the asset, liability, turnover, whatever debt ratios. Debt ratios for us would be basically NPS. So you'll have to, of course, the wording you have to change. So it's applicable to service also. And next question was, okay, need dedicated workshops. Okay, fine, that's fine. Okay, we can, okay, thank you. Many of you have responded. Okay, score of any model is not okay. Now, when you want to deep dive, we have to use more statistical models, or today we can use machine learning models also. See, what happens is the manipulation took place at the transaction level or at a process bypass level. Need not be transaction manipulation, it could be process bypass. Or the manipulation would have probably happened at the some level where data got transferred from one system to the other. We have a lot of problems here: Excel sheets, XML files, staging databases, message queues. I mean, they intentionally keep it that way for adjustment reasons. Okay, that's fine, but the point is, an auditor is not working only at data. Now, if he finds he's using more techniques, and the earlier some of the ratios you used were P&L ratios, some of them are balance sheet ratios, some of them could have been cash flow or other ratios, some of them may be external data ratios. So the relationship when data moves from system to system, if there is a mismatch, will be immediately known through those complex ratios which you are matching and the weights you are giving. That's why I said we have to work out for Indian scenario, because in the Indian scenarios we are more cash driven business. We don't trust people easily. I'm not talking about manufacturing or banks. I'm just saying in general. Trust is something which you build over time, and because our systems are so clumsy and corrupt, you go to court, it doesn't work. You go to the police, it doesn't work. So best is you have to be careful yourself. So that's one of the things, even when you teach the defense people, whatever, what I find is when you do analysis, emotion, and sentiment, trust is something which Western countries is more because their systems work faster, like legal or crime or whatever. For us, it's not going to work. So why take the risk at all? So that's one of the things. So that's why we are, even if you take Aadhaar card and say go get a signature, bring a photo, all kinds of stuff. So that's one of the problems we have. So deep diving needs more mathematical and machine learning models. Then actually this intercompany sales and pricing, this question was asked by Anil Kate, is a very important question because now we are having the GST on intercompany guarantee also, because they give the guarantee, the rates for borrowing come down, but then how much it comes down, how do you value the service? Okay, these are there. Now, just because you pay 28%, you can't get away. Genuine companies will always complain. Fraudulent companies will misuse it. So intercompany transactions, we normally say you have to mirror it and close every month. Okay, every quarter is fine. But intercompany transactions, again, if you have domestic transfer pricing or any external, or if you're merging, hiving off, outsourcing, so many things we have. This is important. The model works there also. It works because sometimes sham companies are used. You would have seen recent GST fraud cases. Most of them are sham companies. So those companies, whatever ratios they're working on, are immediately shown books are cooked. So you can do that. Then variable possible to take on high management frauds. Actually, you can take on the management frauds because one of the main things we teach is management override of controls. But you must understand when we look at phishing, social engineering, it is the top people's identities or credentials which are misused. MD speaking, CEO speaking, and they take away data and mail IDs and so on. That culture is still a problem in India. And China also, where the boss is always right and board is always full of relatives. Many companies, not all companies. Yes, the question is relevant. You can detect the fraud. After that, what to do is the next question. So many of the newer, larger companies, consultants, when they do the risk analysis of the client, because they don't tell the client, but they do some of this stuff and then decide not worth getting into it. So management frauds was asked by Lalit Prasad. Yes, the answer is you can find out, but I mean this method, whatever I'm teaching you now is just find out. That's all. How you are going to resolve the issue, that's a different matter. So that's okay. That's on the part of it. So, is there any other question you would like to ask? You can type it in the screen. I got access to that, so I can see it. If you have no other questions, then maybe we can wind up. I'm actually 20 minutes ahead of schedule. I didn't want to bring in too much of maths because some earlier classes I tried, but it didn't work when we did it for blockchain. Not much interest, so I thought first let's start with normal, absolutely easy number-based stuff. And one more thing is, I asked you to note my email. Please send me a mail. I'll definitely send it back. I mean, send you the spreadsheet also. Those are interested, just send me a test mail. I'll definitely mail this thing to you, the spreadsheet. Spreadsheet is done for students, actually. Student means you're all students, so you can all learn. But as we go ahead, you can build your own models. I mean, not build your own models, build your spreadsheets and Power BI and Tableau and Nine specifically for your requirements. So that will be much more useful, actually. Is that fine? So now, if you have any questions, please feel free to type. Otherwise, I can wind up. Yeah, I can send you the presentation and the spreadsheet also. There are no problems with that. Definitely, yes, I'll send it to you. That's not an issue at all. No, whatever I have, I'll give because everything gets outdated over a period of time. I've been teaching for 42 years now. Um, whatever I told you know, concepts, foundation will never change. Technology, methods, they all change because if I had said something like this maybe even 10 years ago, nobody would have believed me. But today, a lot of MNCs, they all use them. Those who do SOX controls, those who do financial due diligence, mergers, acquisitions, and those are into capital markets. They do all this. So fine, yes, we are happy with it. People believe me at least now. So that's what I'm trying to do. I'll definitely just send me a test mail. No, I'll send this PPT to the institute, to our IASB. I think it'll go on the YouTube or internet. I'm not sure on the web page. But anybody wanting individual stuff also, please mail. I'll send you the PPT and the spreadsheet also. Absolutely no problem. Yeah, that's the only way we can share knowledge because I know India is now growing very fast. We are fourth. Prime Minister wants to take it to third richest country status. We'll have a lot of money to deal with. And as I told you, India is not an easy country when it comes to trust. So auditors will have more and more headaches. And going back to data, yes, we will go back, maybe if needed. Even those lakhs and crores of records will be processed through a tool. But first, let us use the methods like doctors use a scan or a thermometer or even a simple checking your pulse kind of thing to decide what is the extent of damage and what are the tests we want to conduct to know more about the damage. So if it's an inventory fault, you don't have to check the entire company, just check the inventory. That would. If it's a payment fraud, we'll just check the payment. If it's a money laundering fraud, we'll just check the remittances. So that's the skill we really have to build. So the auditing will have to be more in tune with. Actually, I forgot to tell you there are audit guides. I mean, audit standards, audit data analytics from the AICPA Institute, that's the American Institute for Chartered Accountants. You can download the Audit Data Analytics ADA. It's a standard. It was free as a draft. Now they fellows want money. That's okay. Don't worry. Go to the internet. Somebody will post it there. You can take it from there. You can also look up the ICAEW. That's the Institute of Chartered Accountants, England and Wales. You can download their standards also. We have come out with some standards, but maybe not the mathematical component of it. And definitely, I'll talk to the chairman. We can have a session on machine learning also. These are just the macro level eye openers. I try to push in a bit of formula and all that so that you could use them, learn about it, read further. I'm always there to handle your doubts. We have a lot of academic people who are not chartered accountants but do a lot of financial work. They're in IIMs, they're in IITs, they're in the universities because we help the students. The faculty become friends, and sometimes if it's a new problem, they would also like to work on it. They are also excited. So please ask. I definitely. If there's nothing else, can I wind up? Since we don't have any moderators for today, I think we will just check with Mrs. Aarti and then we will wind up. Yes, we can wind up today, and thank you very much for attending the session. I hope it was useful. I got a few positive feedback here. And please feel free, even if you don't understand a word of what I said today, don't worry. I'll send you the presentation. Just send me a test mail. I'll send you the presentation and the spreadsheet. Work with it. It'll come. And I'm always there to support you. So don't worry. So thank you very much and wish you all the best.